If the investor invests equally in both the company, what will be the portfolio return and risk? When you say that probability is given, it is called ex ante. If the probability is not given, it is called ex post, we say. Find out the expected return, no standard deviation is asked. Then portfolio return, risk, covariance and standard deviation is there. Formula, remember, standard deviation x square, wx whole square, standard y square, wy whole square, 2 into standard deviation x. Hello my dear student, very good morning to one and all. I am Dr. B.S. Subramaniam, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram, First Grade College, a Temple of Excellence, MYSURU. I am going to add Financial Management 4, FM4, 6th semester, Unit 5, Session 1, in favor of B.B.A. This goes in favor of Portfolio Risk and Return. This is the Unit 5, first session with Portfolio Management. We are going to discuss today expected return, standard deviation, covariance, correlation, and risk on portfolio. Everything we are going to discuss now in portfolio management. Portfolio means diversification of our securities. So we will give the weightage for each security. If the two securities are given, risk on portfolio is equal to root of WA square standard deviation 1 square plus W2 square standard deviation 2 square plus 2 into WA, WB, standard deviation 1, standard deviation 2 into R. So we have to calculate everything. So R is equal to covariance, standard deviation of A, standard deviation B. So when the probability is then, how to find out the expected return? R into probability, that is your expected return. Then take the deviation, R minus R mean, square of that, multiplied by PD, that's a PD square. Then your standard deviation is equal to root of PD square. Whatever you get is your standard deviation. Then what is your covariance? No? You take the deviation of x, deviation of y multiplied by b. The p into dx and dy is a covariance. Your correlation is R is equal to covariance divided by standard deviation x divided by standard deviation y. Slowly we move on to problem and get solved. This is a definite problem from the examination point of view. So these are all the things they have given. So what they are expecting now, what they want now, expected return, number 1, expected return, what they require, then standard deviation they require, then covariance they require. What are the requirements are? Covariance, then they require correlation, then if the investment is 75% A in A, 25% B, what would have the portfolio return? Risk on portfolio they ask. If the investor invests equally in both the company, what will be the portfolio return and risk? So they ask the both common expected return also, portfolio return also. We'll go slowly one by one now. Company A, returns of percentage of company A. Returns. Company A returns -4, 18, 24, 30, 26. So these are all the returns. R1 we can say. Probability. What are the probabilities are? 0.2, 0.3, 0.2, 0.2, 0.1. See that if we add the probability is equal to 1, it's 1. Then R into P is your expected return. Multiply -4 into 0.2 minus 0.8. 18 into 0.3, 5.4. 24 into 0.2, 4.8. 30 into 0.2, 6. 26 into 0.1, 2.6. This is your expected return. 2.6 plus 6 plus 4.8 plus 5.4, 18.8 minus 0.8 is 18. Expected return is 18. Then RA minus R mean A. You call this as dx. -4 minus 18 minus 22. This is your return. -4 minus 18 is minus 22. 18 is 0. 24 minus 18 is 6. 30 minus 18 is 12. 26 minus 18 is 8. Then RA minus R mean A whole square. This is your dx square. 22 into 22, 484. This is 0. This is 36. 144, 64. dx square. Then multiplied by P, dx square. Multiplied by dx square. 484 into 0.2, 96.8. Then 0, 36 into 0.2, 7.2, 144 into 0.2, 2.8, 64 into 0.1, 6.4. Add dx square. Add 6.4 plus 2.8 plus 7.2 plus 96.8. Sigma dx square 113.2. Slowly. Standard deviation is equal to root of 113.2. Root of this 10.64. So you find out the standard deviation. So here you get the standard deviation. Then what he wants to know, he see that so each company. Covariance means both the companies has to look after covariance. Then covariance is deviation of x and deviation of y has to come p into covariance. Deviation of y has to come. Then only we can go with. We go with company B. Returns are common standard deviation. You find out. Returns are company B minus this is company Z. Returns are -3, 6, 11, 14, 19. Add the figure. 19 plus 14 plus 11 plus 6 minus 3, 47. Sorry, not necessary. Your probabilities are, because probability is given 0.2, 0.3, 0.2, 0.2, 0.1. Expected return R into P, multiply 3 into 0.2 minus 0.6. This is called, when you say that probability is given, it is called ex ante. If the probability is not given, it is called ex post, we say. It is called problem of ex ante. So then 6 into 0.3, 1.8, 11 into 0.2, 11 into 0.2, 2.2, 14 into 0.8, 0.2, 14 into 0.2, 2.8, 19 into 0.1 is 1.9. Add the figure, because probability is given. When the probability is given, multiply return with probabilities. So add the figure. 1.9 plus 2.8 plus 2.2 plus 1.8, 8.7 minus 0.6, 8.1. Expected return 8.1. Repeat once again. 1.9 plus 2.8 plus 2.2 plus 1.8 minus 0.6. 8 your expected return. Then R minus R means Z. Take the division. Your R is here. Minus 3 minus 8 minus 11.1. 6 minus 8.1 is minus 2.1. 11 minus 8.1, 2.9. Then 14 minus 8.1, 5.9. 19 minus 8.1, 10.9. You can call this as dy. Then dy square of this 11.1 into 11.1, 123.21, then 2.1 into 2.1, 4.41, 2.9 into 2.9, 8.41, repeat, 2.9 into 2.9, 8.41, 5.9 into 5.9, 34.81, 10.9 into 10.9, 118.81, multiplied by probability, dy square into p. So 123.21 into 0.2, 24.64, 4.41 into 0.3, 1.323, 8.41 into 0.2, 1.682, I will repeat, 8.41 into 0.2, 1.682, 34.81 into 0.2, 6.962, 118.81 into 0.1, 11.881, add the figure, 11.881 plus 6.962 plus 1.682 plus 1.323 plus 24.64, 46.488 sigma pdy square. Standard deviation is equal to root of sigma pdy square is equal to root of 46.488 root of this 6.82%. Then we'll move on to covariance. Covariance. So P into dx dy, first we write dx, what's the deviation of x? Minus 22, 0, minus 22, 0, 6, 12, 8. dx 0, 6, 12, 8. dy, deviation of y, minus 11.1, then minus 2.1, next 2.9, next 5.9, 10.9. dx dy 11.1 into 22, 244.2. This is 0. 2.9 into 6, 17.4, 5.9 into 12, 70.8, 10.9 into 8, 87.2, multiplied by probability. What's your probabilities? R 0.2, then 0.3.2, 0.3.2, then 0.2.1. So P dx dy to 244 into 0.2, 48.8, this is 0, 17.4 into 0.2, 3.48, 70.8 into 0.2, 14.16, 87.2 into 0.1, 8.72. Add 8.72 plus 14.16 plus 3.48 plus 48.8, 75.1. Covariance. Covariance. Then R is equal to covariance divided by standard deviation X into standard deviation Y. This is 75.16 divided by, come back to company A, standard deviation is 10.64 into standard deviation Y 6.82, 75.16. Returns are there, PDX square is there, 96.6, 10.64. Then B dy square multiplied this 46. 46.6.82. So it is 10.64, 10.64 into 6.8, 72.35, 75.16 divided by 72.35, 1.03, 1. So your correlation is 1. R is equal to 1. Then this over, investment 75% in A. portfolio WA 0.75, WB 0.25. Slowly you have to apply. So, risk of portfolio, return of A into WA plus return of B, Z, WZ. Now, what's the return of A? First one, expected return 18 into 0.75. What's Z? What's the return? 8.1 into 0.25. Multiply 18 into 0.75, 13.5 plus 8.1 into 0.25, 2.02 is equal to plus 13.5, 15.52%. Then regarding the portfolio risk, slowly, root of the standard deviation A square, WA square, standard deviation A square, WA square, standard deviation Z square, WZ square, plus 2 into standard deviation A, standard deviation Z, weight of A, weight of Z into R is equal to root of, what is standard deviation A? What's it? PDX square. Standard deviation A is 10.64 whole square into 0.75 whole square. What is standard deviation 2? 6.82 whole square into weight 0.25 whole square plus 2 into 10.64 into 6.82 into 0.75 into 0.25 into 1 R is equal to root of 10.64 into 10.64, 113.21 into 0.75 into 0.75, 0.5625 plus 6.82 into 6.82, 46.51, 0.25 into 0.25, 0.0625 plus 2, 2 into 0.2 into 10.64 into 6.82 into 0.75 into 0.25, 4.19 Root of this 113.21 into 0.5625, 63.68 plus 46.01. This will come 6.82 into 6.82, 46.51 into 0.0625, 2.91 plus 4.19. So root of this, remove the root, 2.90 plus 2.91 plus 63.68, root of 69.49, root of this 8.33%. This goes to 75%, 25%. Another equally, if they have invested equally. Risk root of standard deviation A square 10.64 square into 0.50 whole square plus 6.82 whole square, 6.82 whole square into 0.50 whole square plus 2 into 10.64 into 6.82 into 0.50 into 0.50 into 1. What's the formula? Standard deviation 1 square into W1 square, standard deviation 2 square, W2 square, 2 into standard deviation 1, standard deviation 1, WA, WB. Simplify. 10.64 into 10.64 is 113.21 into 0.50 into 0.50, 0.25 plus 6.82 into 6.82, 46.51 into 0.25 plus 2 into 10.64 into 6.82 into 0.50 into 0.50, 36.28. So simplify this. Root of this 113.21 into 0.25, 28.30 plus 46.51 into 0.25, 11.63 plus 36.28 plus 36.28 plus 281. This is 113.21 into 0.25, 28.30 plus 11.63 plus 36.28. Root of this 8.73%. 8.7. Little bit lengthy, but we have to do carefully. So returns of A, returns of B, same is there. Find out the expected return. If the investment is 30%, find out the expected return. No standard deviation is asked. Then portfolio return, risk, covariance, and standard deviation is there. We'll move to expected return. Company A. Company A. Returns are 2012, 6 probability 0.5, 0.3, 0.2, 0.5, 0.3, 0.2. Expected return R into P. 20 into 0.5 is 10. 12 into 3.3 is 3.6. 6 into 0.2 is 1.2. Add 14.8 expected return. Then RA minus R mean A. This is your dx, deviation to the R. 20 minus 14.8, 5.2, 12 minus 14.8 minus 2.8, 6 minus 14.8 minus 8.8. Then dx square 5.2 into 5.2, 27.04, 2.8 into 2.8, 7.84, 8.8 into 8.8, 77.44. Then pdx square multiplied by probability 77.4 into 0.2, 15.488, 7.84 into 0.3, 2.352, 27.04 into 0.5, 13.52. Add the figure 13.52 plus 2.352 plus 15.488, 30 sigma pdx square 31.36. Standard deviation is equal to root of 31.36, 5.6%. This goes in favor of company A. Company B, returns are 15, 8, 13. Your probability 0.5, 0.3, 0.2. R into P, expected return 15 into 0.5 is half of that, 7.5, 2.4, 2.6. Add the figure. 7 point, if you want, 15 into 0.5, 7.5, 8 into 0.3, 2.4, 13 into 0.2, 2.6 plus 2.4 plus 7.5, 12.5 expected return, 12.5. Next, or mean, or B, or mean B. This is your dy. Written 15 minus 12.5, 2.5, 8 minus 12.5 minus 4.5, 13 minus 12.5, 0.5 dy square, 2.5 into 2.5, 6.25, 4.5 into 4.5, 20.25, 0.5 into 0.5, 0.25, multiplied by probability, p dy square, 6.25 into 0.5, 3.125, 20.25 into 0.3, 6.075, 25, 0.25 into 0.2, 0.05, 0.05 plus 6.075 plus 3.125, 9.25. This is sigma p dy square. So standard deviation of y, root of 9.25, 3.04%. So we calculate that now. We'll move on to the covariance. DX company. First is DA, deviation of A, you call as DX. The company DX is there. 5.2, then minus 2.8, minus 8.8, dy, deviation of y, deviation of y, 2.5 minus 4.5, last one, minus 0.5, then dx dy 2.5 into 5.2, 13, 4.5 into 2.8, 12.6, minus into minus become plus, 8.8 into 0.5 minus 4.4 multiplied PDX5 multiplied by probability 13 into your probability is 0.5 into 0.5 6.5 12.6 into 0.3 into 0.3 3.78 4.4 4.4 into 0.2 4.4 into 0.2 0.88 add 11.16 this R is equal to covariance divided by standard deviation x, standard deviation y, 11.16 divided by standard deviation first one, 5.6 into second one, 3.04, 11.16. This is 5.6 into 3.04, 17.02, 11.16 divided by 17.02, 0.65 R. Come back here, this over. If the investment is 30% in A, 70% in B, what would have been the portfolio return? This is return on portfolio or mean of X, WX, or mean of Y, WY. So what's your R mean here? Expected mean 14.8 percentage, 30% in A, 0. Into 0.30 plus R mean of Y, expected mean 12.5 into 0.70. This is 14.8 into 0.30, 4.44, 12.5 into 0.70, 8.75 plus 4.44, 13.19 percentage. Then portfolio risk, root of first one, standard deviation x square, wx square, standard deviation y square, wy square, plus 2 into standard deviation x, standard deviation y, wx, wy into r is equal to root of First one. What's your standard deviation x? 5.6 whole square into weight 0.3 whole square plus 3.04 whole square into 0.70 whole square plus 2 into 5.6 3.04 into 0.30 0.70 into 0.65 is equal to root of 5.6 into 5.6 31.36 into 0.30 into 0.30 0.09 plus into 3.04 10.34 into 0.70 into 0.70 0.49 plus 2 into 5.6 into 3.04 into 0.30 into 0.70 into 0.65 4.65. Simplify. Root of this 31.36 into 0.09 2.82 plus 10.34 into 0.49 5.07 plus 4.65 5.07 plus 4.65 plus 2.82 is 12.53. Root of this 3.54. Standard deviation is equal to 3.54%. If they invested 70% and 20%. Last one. So WA equally means 50%. This is WX. WY is 0.50. Then risk of portfolio root of standard deviation x square WX square standard deviation y square WY square plus 2 into standard deviation x into standard deviation y into WA W of x into W of y into R. Formula remember, standard deviation x square Wx whole square standard y square Wy whole square 2 into standard deviation x standard deviation y weight of x weight of y into correlation. Come back. Root of what is standard deviation of x? Standard deviation of x 5.6 5.6 whole square here last year into 0.50 whole square plus what's your standard deviation? Y standard deviation 3.04 into 0.50 whole square 2 into 5.6, 3.04, 0.5, 0.5 into your R is 0.65. This is called root of 5.6 into 5.6. 5.6 into 5.6, 31.36 into 0.50 into 0.50, 0.25 plus 3.4 whole square into 0.5 whole square, 3.5 into 3.5, 12.25 into 0.25 plus 2 into 5.6 into 3.04 into 0.5 into 0.5 into 0.65, 5.53. Simplify root of this 31.36 into 0.25, 7.84 plus 12.25 into 0.25, 3.06 plus 5.53 root of 3.06 plus 5.53 plus 7.84, 16.4, 4325. Root of this 4.05 percentage. Last one, return on portfolio R mean X, WX, R mean Y, WY. R mean X is 14.8 into WX 0.50 plus what's your R mean Y? Second one, R mean 12.5 into 0.50. 14.8 into 0.50, 7.4 plus 12.5 into 0.50, 6.25. So return on portfolio is equal to plus 7.4, 13.65%. It will be lengthy, but you must be very careful. Square, this one. First square, weight square, second square, 2 into standard X, standard deviation, weight of X, weight of Y into R. So we have done standard deviation, covariance, risk on portfolio, return also, weight also. Everything we have done. Hope you understand. We'll have some more problem of this type in the next class. Till then, goodbye. Meet in the next class. Hope you have followed. Slowly go through it. You can understand this. We'll meet in the next session. Till then, goodbye.